Mortgage rates often and always fluctuate due to market conditions, and there has been a lot of fluctuations over the past 4 to 6 weeks. However, what you can control is your credit score and debt-to-income ratio. So I wanted to talk about how interest rates play a key role with credit scores. So your credit score is super important, especially where it comes to conventional financing, where 70% of Americans get their financing from. Other types of loans like government loans include FHA, VA, and USDA rural development. Well, those loans give you a better interest rate if your credit score is, say, 660 or 680. Where a conventional loan, you really need to get at least to a credit score of 720 to have more premium interest rates and reduced private mortgage insurance or PMI factors. All right, so let's talk a little bit more in depth about it. If you're getting a government loan, you can expect your rate right now to be around 5.5% to 5.99% if you have excellent credit on a government loan. When you get into lower credit scores, you can expect the interest rate to be 6 to 6.375. In the conventional world right now, the baseline interest rate as of now is 5.99% to 6.375 if you have fantastic credit. And then you can get, I would say, up to 6.75% after that with lower credit scores. Well, the problem with that is that it might cause you to move out of a certain area in a house market because that's could have a variance of $40,000 to $60,000 of buying power, or cause your payment to be higher by $200 to $300, for example. So having a really good interest rate is important, and it's also cool to know that interest rates and programs move in 20-point increments. So, for example, 700 to 719 is a bucket, 720 to 739 is another bucket, etc., all the way up to 780 and above credit scores. And in mortgage lending, the highest credit score is 850. In consumer lending and consumer credit reports like a Credit Karma, Credit Sesame, even probably Capital One card credit score, it's 900. So the highest score in mortgage lending is 850. And so in the highest bucket, 780 to 850 is the best bucket. Once you're there, then you have the premium interest rates, the lowest PMI insurance, the lowest factors. Also important to know is debt-to-income ratio. So once you have a higher threshold in debt-to-income ratios, in other words, all of your bills, including your new house payment divided by your income, will give you an interest rate as well. And so if you creep above a ratio of 45%, then you'll have usually a higher PMI factor and sometimes a higher interest rate. So two key components is keeping your interest rate in check is to have the best credit score that you can have at the time of purchase and lower debt-to-income ratios. So how do you know this? The key is to talk to a professional, a great mortgage loan officer such as myself, or someone in the business that understands mortgage lending and how it correlates fantastically to interest rates, and looking at your credit score, looking at your credit profile and giving you suggestions. Close this credit card down. It's only been open for 8 months. Become an authorized user on your spouse's credit card. It's been open for 65 months. Those are the kinds of things that will generate and boost a credit score in as little as 30 days. And so if you want to strategize on the best time to lock an interest rate and having the optimal credit score, give me a call. We'll walk through those scenarios for you and your clients. As a real estate agent, it's really important to help your client get the absolute best. And sometimes that doesn't just come from the market. It also comes from that person doing their best on the credit scores and debt ratio. This is Dawn Connors at Mortgage One, providing you fantastic mortgage solutions.